There is a lot that has happened in the past month, so I want to update you guys on things. The topics of discussion are going to be tariff and trade deals, the US credit downgrade, which is a big one, interest rates, recession risk, and then we're also going to take a quick peek at a big, beautiful bill, which is essentially the tax proposal and also in turn the benefit changes. When we had those tariffs implemented on April 2nd under Liberation Day, there was shortly after that a 90-day pause. That pause is going to end here on July 9th. That is when these tariffs are set to go back into place. I know that there's a lot of things going on in the courts and appeals courts. And as of right now, we do believe that they will still be able to implement tariffs at least to some degree. So our eyes are really going to be on just what trade deals there are, what terms they can work out, and how many of them come through here really over the course of the next month. So the market volatility that we might see will likely pick up June as we approach that July 9th date. So one of the things we should do is we should look at, well, which trade deals are more crucial, right? Who do we really do business with? So the top trading partners are Mexico, China, and Canada. European Union is kind of spread out here amongst a few of these countries, so they're not as far down on the list. I would actually really kind of push them up more towards being that third or fourth major trading partner. So those are the ones that matter the most. I know that we do have a deal in the works with the UK, and we're going to talk about that. So talking about Mexico and Canada, there was an agreement back in 2020 called the USMCA, the US Mexico Canada Agreement, very original. And that was set up in 2020 and was due to be re-reviewed in 2026. So what has kind of transpired since 2020 is the US has continued to have a large trade deficit with Mexico. The deficit with Canada has been increasing since this was signed in 2020. And almost all of the fentanyl in the US comes from Mexico, 98% actually. And the US is basically saying, hey, Mexico, we want you to help us with this issue. So it's kind of an either or a combination of closing the deficit with Mexico, getting their help, or some combination of the two. The other part that Trump's administration is claiming is that Canada and Mexico are allowing mass numbers of illegal immigrants into the US. They want their help to have more enforcement at the borders. So hopefully in the next month, we get a lot closer to hearing about some sort of deal with Mexico and Canada. The other one here is China. So it's actually really interesting seeing what we import and export to each other. So for the US, soybeans, aircraft and engines, integrated circuits, pharmaceuticals, petroleum. And what China's exporting to us is smartphones, right? Think Apple, think Samsung, laptops, batteries, toys, and telecom equipment. Think about which companies produce smartphones and laptops, right? You're looking at Apple, you're looking at Samsung, you're looking at even chip providers like Intel, NVIDIA. A lot of those top things impact some of our top US companies, right? Some of the larger companies in the market. So they have more exposure here to China, which is a concern. Now, the current situation with US and China is that we are currently on a pause. There's a trade war truce between the US and China, allowing some time to try to work out differences. So China is our second largest trade partner. They do need us more than we need them, but they are still our second largest trade partner. So we do definitely need to get something worked out. The US was placing tariffs on China at 145% after Liberation Day, and that has been decreased down to 30%. Now, China had low tariffs on the US. They kicked it up to 125% in retaliation, and they have also, in this truce, lowered or reduced that down to 10%. So until the trade deal is reached with China, China is going to be probably one of the main ones to look for. That's going to drive a lot more volatility in markets. Mexico and Canada, we are more likely to end up working out a deal. So I think people are not as concerned about that. I think China is really the bigger concern. Now, let's talk about another one, because there was a lot of volatility that happened actually a couple of weeks ago, actually last week, I should say, with the European Union. Things escalated, then Trump backed off. Basically, right now, the European Union is seeking zero tariffs. They basically want no tariffs between us and them. just free trade with each other. The US or Trump administration is looking for 10% tariffs due to the fact that we are importing more from them than they are importing from us. The UK trade deal, we have a little fact sheet, right? So we do have a deal that is in the midst of being signed. I know that there was a lot going on again with the courts and appeals courts to try to block some of these tariffs, but it does at the current time sound like this is still on its way to be signed, but this would give us access to 5 billion more in exports. The tariff revenue that we would be charging them would lead to 6 billion in revenue. UK tariffs on the US, they were 5.1%, 1.8%. Now, for the US, we were charging the UK 3.4%. That's now going up to that baseline that Trump is looking for most countries at 10%. So they're going to be charging us less. We're going to be charging them more. And in turn, that's going to lead to more money coming in. We're going to kind of shift away here a little bit from tariffs, and we're going to talk more about the economy. And we're going to talk a lot about inflation and interest rates and how all of that's factoring together. So first off, the M2 money supply. This is the amount of money that the Federal Reserve has printed and has in circulation is nearing all-time highs. And this is a concern because printing money is, of course, inflationary. It puts more money into circulation, thus prices of goods go up. So let's talk about the credit downgrade. So Moody's is one of the major rating system out there. And this basically raises concerns about the United States, their ability to pay on their debt. Now, their debt would be things like US Treasury bonds. This can also lead to higher interest rates on Treasury bonds, which will essentially make our national debt go up, which is already a problem. The other thing is it can also trickle down to the consumers. That means things like mortgages, car loans, credit card rates. Those are all likely going to be inching a little bit higher. Now, I do know the Trump administration did mention something about trying to put a maximum that credit cards could charge. I think 10% was the number they were talking about, which I think would be a good thing, not for those companies, but it would be a good thing for the consumer. But if they don't, or until they do, we might see those rates start to trickle higher or at least just stay higher for longer. The 10-year Treasury yield tends to dictate what happens in the bond market. Same thing with mortgages. The 10-year Treasury right now just got up to the same level. In fact, actually a little bit higher than it was in 2008. That shouldn't necessarily be a concern because as you can tell from this chart, it's been at this level or more for actually most of the time, right? We've just had a long period here where we've had these lower treasury yields. And the main reason for that is just because we had some major market crashes, right? We had 2000 into 2008. So we're actually closer to the average right now. And what this means is that we're going to have a very different circumstance here in the bond market. So for any of you who are approaching at or in retirement, really bonds are going to be a more viable option. We just haven't seen a ton really happen with them until the Federal Reserve really starts to cut these interest rates. And we will talk about that as well. But seeing how quickly this is elevated, we might not be done yet, especially with the downgrade to the US credit score, essentially. We might see that drift even a little bit higher. Now, on the flip side, core inflation continues to ease, right? It's continued lower even throughout all this chaos this year. So this is a great sign for the future of interest rate cuts. But the Federal Reserve has mentioned several times that they are going to wait and see. I want to emphasize those words, wait and see. They want to see the impacts of these tariffs. And when we look at a lot of these economic factors, they take around 6 months before you can actually see the true result. I'm sure just like myself, you guys probably see a whole bunch of headlines and then you see a headline the next day or the next week that contradicts the first headline. And it's because things are just ping-ponging all around and things are changing very, very rapidly. So there's a lot of articles and things that have been coming out saying, hey, the Federal Reserve might cut rates in June, then they moved it to July. Now they're saying September, and even some of them are saying a second rate cut in December if they do it in September. There are others, like myself, who believe that we won't see a rate cut until December. And I would actually say if we even see one this year. Now, I did think I would add a little humor in here today. And if anybody knows the show Friends, this is kind of mimicking that. But Jerome Powell says basically, hey, say this with me. Interest rates will be higher for longer. Now, put it all together, interest rates will be higher for longer. And what the market is basically saying right now is, oh, okay, so rate cuts by the end of the year, which is not at all what he's saying. But every time we get some good piece of news that might lead to the Federal Reserve cutting rates, like weaker job numbers or higher unemployment or a lower inflation number, everybody starts to say, oh, okay, so now maybe the Federal Reserve is going to reconsider this rate cut. But really, this year, the Federal Reserve has maintained the exact same stance. They've used different words, but they've said, hey, we want to see what happens first. We want to wait and see. This year, we're not going to see it really probably take off, but we'll see it be more steady than what it's been in past years. Now, the other part that the Federal Reserve needs to look at is our GDP, right? In the first quarter, this was negative, right? And it was negative for the first time since the first quarter of 2022. Now, the old official definition of a recession was 2 negative quarters of GDP equal to recession. That was redefined under the Biden administration to say, hey, it's not just 2 quarters. It also depends on other factors like the labor market. So we haven't seen the effect of tariffs. Tariffs could push us into having a second quarter of negative GDP where there could be a recession, there could not. But then maybe if we do have some good trade deals, maybe that would lead to GDP then picking up and reverse. The other factor when it comes to interest rates and also GDP is unemployment claims. They are still rising. Now, you might recall if you watched the commentary back in May or April where we talked about unemployment going up, but it's actually still below the long-term average. So even though it is lifting higher, we have some wiggle room before it even gets to the average, let alone getting to a point where we're concerned about it. But this is another metric on top of just the inflation or consumer price index that the Federal Reserve is watching. So even though these are rising and they're at the highest level since November 2021, they're not at a level that we should be concerned about just yet. So let's talk about recession, the big R word that very likely we're going to start to see in headlines a bit more, probably starting next month, right, in July. So I wanted to share a couple different places that rated the probability of a recession just to show you how vastly different institutions are when they come to judging this, right? Because there's a lot of uncertainty. JP Morgan just reduced the risk of a recession from 60% to 40%, right? So they think things look to have improved a little bit. Meanwhile, the International Monetary Fund, IMF, upgraded the risk from 25 to 40%. And there's a lot of other companies that have rated all across the scale, right? But the reason I want to share this is these two companies, both from very different viewpoints, have narrowed it down and they're coming more towards the middle, right? In other words, we're starting to see a lot more companies come to a more reasonable number that more of them are agreeing on. And in turn, they're also forecasting if we do enter one, it would be very shallow. Now, there's another metric which judges the probability of a US recession based on the yield curve. This is currently at a 30% probability of recession. And I'm sure as you guys can see, if we just back up a year or 2 years ago, that risk was over 60% and it didn't happen, right? So just because the risk goes up doesn't mean we're going to have a recession. But what we can take from this is, hey, that means things must be improving, right? 2 years ago and a year ago, it looked like there was a higher chance of a recession than there is today. So we might be able to avoid that, but it's just going to depend on, again, all those other factors. Let's jump into a big, beautiful bill, as they're calling it, the tax proposal. I know we've all seen headlines. We've probably seen headlines with Elon and Trump kind of going at it here in disagreements. The big thing here is the tax proposal is going to increase our debt, right, as a country. And there are concerns about that because we already have a very high amount of debt. Personal opinion, taxes probably go up later on because we're going to need to counteract that. In the short term, though, we want to take advantage of this if this gets passed. So for a lot of you on the line who I work with, we're doing Roth conversions, or we've spoken about doing Roth conversions. And this year it's been more of a wait and see as well, right? Just like the Federal Reserve, we're waiting to see what the tax proposal actually looks like. So one of the big parts, the most expensive part of this bill is to extend the Tax Cuts and Job Act. the TCJA, which means the percentages, and also the larger standard deduction. You might recall back in 2017, a lot more people were itemizing their return than taking the standard deduction. Now, another one, very interestingly, that will benefit probably a lot of you on the line here is increasing the SALT, the state and local income tax, plus property tax cap. Currently, $10,000 is the maximum that you can claim as a deduction for all of the state and local income tax that you pay plus your property tax. So the proposal here is to increase it to a range, which will be 12K at the lowest, 40K at the highest, and it would scale depending on your income. When we had these original tax changes happen in 2018, if you saw your tax bill go up than the year before, this was very likely that main reason. Other things that don't say necessarily impact probably most of us would be increasing the estate tax exclusion from 15 million for a single person, 30 million for married. I think right now it's like 12.5 million for single and 25 for married. Increase the child tax credit to 2,500 until 2028. Then it would drop down to 2,000. No tax on tips and overtime. Significantly reduce the tax credits for green energy. So anybody who got solar might not be as beneficial as it once was. There's going to be more information on this to come. I do plan to make a video on this as we get more information on the different things. This is not everything. The actual proposal is a very lengthy item. This is just the ones that I chose to pick out to share with you. Now, as tax rates go down, our debt goes up, right? Pretty common sense. Since our debt came down in about 1985, or sorry, I should say top tax rate, and we've kind of leveled off here. It's kind of gone up and down a little bit, but the top tax rate has been kind of consistent here. Nothing like it was in the past. Now, if we look at our national debt, 1980 was really the time that really took off. So the concerns that I have really when it comes to our national debt is all these changes are going to actually essentially keep this top rate where it is and extend it, as they said, permanently, but more so that just means it's going to stay higher until some future administration can change that. But it does, in my opinion, it needs to change. There's a reason that Europe and all these Asian countries have, top tax rates in the 40% is because they figured out what worked, right? We are, in comparison, a newer country. So the tax planning, the Roth conversions, that means we want to take advantage of that now in the anticipation that these different tax rates are very likely to go up in the future. The other part here is a big, beautiful bill is expected or projected to add $3.5 trillion to our national debt. And when you combine that with our credit rating being downgraded, that can lead to an even bigger issue. So one of my personal beliefs is that these cuts to federal benefits, these cuts to Medicaid, I personally think this is just the beginning. I think as our debt continues to climb, we're going to see more changes in the future. And that's why these conversions are geared to basically hedge you against that future risk. So what can you do, right? Number one, when it comes to investing, is you want to stay invested. I talk with far too many people. They move everything to G Fund, some combination, they pull money out. You want to stay invested. Whatever risk level you're taking, keep your money invested. If you're in the inappropriate risk level, that's a different story, which we're going to talk about here. Stay diversified. And if you're not diversified, right now is a great time to change that because the market fell off a cliff and it's already basically come back. We are just about completely back to where we were, which should not, in my opinion, have happened already. We don't have all these trade deals and things with these other countries. This risk is still there. So if you need to diversify more, if you need to change your investments, now is the perfect time because it's probably not going to last that long. We might have a couple weeks, some news comes out, markets fall 5%. And the next thing that is the hardest, but probably the most important here is tune out the noise. Headlines can make things scary. Remember, fear gains attention when it comes to the media arena, right? Fear sells in the news, but when it comes to the market, there is almost always something to be fearful of, right? There is some risk or multiple risks on the horizon. So stay invested. So thanks, guys, for your time. And I will see you all in the next commentary. Take care.